Welcome, everybody. I'm Jennifer Phillips Russo, and I'm here today with Kevin Martin. This is our weekly podcast for the Lake Erie Regional Grape Program. And today, Kevin's going to talk to you a little bit about liquidity, what it is, why it matters, and what we do about it. Kevin?
Sure. So it's hard to pick a good time to talk about this because you should really be paying attention to liquidity at first in December or January to figure out what's going to happen to your operation in the next year. That's going to give you the best time to make a plan, see if there's going to be a problem, and then maybe react to that problem. If that didn't happen, typically in July or August, unless there are really severe problems on the operation, that's when you'll actually have a cash crunch, which is what liquidity is trying to measure. So basically what liquidity is the operation's ability to pay current liabilities, comparing your current assets, which essentially eliminates assets and liabilities that are not current. So what I mean by that is, if you're looking at the health of your overall operation and profitability, you're thinking about the mortgage you're going to have to pay in 15, 16 years, that mortgage payment 16 years from now. Liquidity completely ignores all of that. We're just looking at what you're going to owe over the next 12 months and what you're going to get over the next 12 months.
So why would you measure it?
Yeah, so maybe what I just said might make that obvious, but I think we can delve into it a little deeper. We want to make sure that even if you have a profitable operation, that you can pay your bills, because that'll happen. And it happens in businesses like this that are capital intensive. You look like you're worth $1 million on paper, but you can't pay your taxes or you can't pay the spray bill because you have so much tied up in your long-term assets. So we want to pay close attention to our short-term assets and our liabilities.
How are you going to measure that?
So there's a couple of different ways to measure it. I think for grape growers, probably the best way is to just look at your current ratio. So again, you take a look at the assets and the liabilities and you convert it to a ratio. So bills are likely going to include something between $700 and $1,000 per acre in production practices. That will vary and could get significantly lower than $700 if you've prepaid for a lot of purchases. So, it's something you want to look at for yourself. You don't want to just use that $700 number. And you want what's in your checking account in probably the beginning of December before you start pre-purchasing goods, or the end of November, to be equal to 1.5 to 3 times of that amount. So $2,100 per acre, using that $700 number. Growers that, if you haven't purchased a vineyard in the last 10 years, if you are not 25 years old, and in particular, if your business is not, 5 years old, you want to get that ratio as close to 2, if not 2.5 as you can. If you're exclusively selling to the cash market, especially as your business matures, you want to be closer to 3. So the reason you're at 3 is because you're getting paid either in October, November, or December, and that's it. And you're done. So your current ratio should look a little bit healthier. Whereas, in the cooperative market, some of your crop is going to not be a current asset. It's going to be a future asset because you're not going to get paid for more than 12 months. So you're going to end up with a slightly lower current ratio, and it's going to be okay if the business is young. Wineries should, go ahead.
I was just going to say, so when is it a problem? It's a problem more like now?
Yeah, so if you have a current ratio that was less than 1.5 in January, there's a good chance in some years that you would start to be concerned about running out of cash typically in August. This is again going to depend on where you sell your crop. National grape payments have been typically timed to this time of year, so it could be July for you, especially right now, because payments in that cooperative are rising. Payments in all cooperatives are pretty healthy. So because they're rising, it's more likely that cash crunch came earlier. So you probably just got a fairly large payment, larger than what you were expecting. If you had cash issues, it was probably before that. Because if you were forecasting a payment, if you were trying to come up with a forecast of your liquidity in January, you would not have forecasted the payments that you got from Welch or even Growers Co-op if you were doing a conservative forecast. Those payments have come in higher than expected. Now, with the cash market, I would expect hopefully prices to continue to slightly rise a little bit. We'll know in a couple more weeks, but the premium that they received because of COVID and the increase of demand wasn't realized to growers because it all happened after the crop was sold. So for the cash market, this would definitely be the time. If there was a liquidity issue, this is when it would happen.
So what could they actually do about it if there was a liquidity issue?
So if you're having long-term liquidity issues, you should definitely carry crop insurance to make sure your cash flow remains robust, whether there's a disaster or not. So, until you see that hit too, that's just one more reason to make sure you have crop insurance at 75% and 100% of price. There are certainly avenues for borrowing money that take time. As your business struggles a little bit more, you may need to turn away from something like farm credit and towards something like USDA. So that's going to take even more time. There are also going to be, if you're borrowing for assets, sometimes USDA is actually the right place to go. Sometimes it's a traditional bank or a non-bank, like the dealer you're borrowing from, just depending on what the terms are and the interest rates. But all of that borrowing can help your liquidity ratio. I don't necessarily want to encourage growers to take on tons and tons of debt, but it is a better alternative if you're really studying your business and you're seeing that the business is growing a lot on paper and you're growing all these long-term assets, but you're going to struggle to cover short-term liabilities. I think that really justifies debt. You've got a healthy operation. Overall, you're profitable. You just need to make sure you can buy posts this year. That's a good reason to take on some debt, and it's a good time to do it. It's relatively cheap. I think the other option, the thing growers like to turn to, is modifying production practices. For the most part, if your business is profitable in the long term, you really want to think critically about undermining that long-term profitability just because you can't swing, an insecticide material, because that's going to undermine your long-term profitability. So I know growers like to do that. I know, from a personal standpoint, that represents probably good fiscal practices on a personal level. You don't buy a new truck or a new car when you don't have the money, and that in the long run is probably going to help you out. But your personal expenses typically don't lead to a return on investment, and your business expenses do. So you really want to think critically about that, especially when debt is so cheap. But the one thing I want to mention is what wineries should look at, and potentially some grape growers, depending on what you're doing. If you're a traditional grape grower, you just sell to a processor. The current ratio is a great way to measure liquidity. If you're a winery, you really want to use something called a quick ratio. And the difference between the two ratios is you eliminate looking at your inventory. Winery inventory can be a substantial part of your net worth even, and it's not necessarily easily converted to cash. I think some of it is, but trying to rely on 100% of it being converted in the next 12 months is questionable. So your quick ratio isn't going to include that inventory. I think that puts you in line with standard businesses, which means a result of one is healthy. As long as you're not counting your inventory, if you have enough cash on hand and other assets that you can turn into cash quickly, and you can cover 12 months of expenses, you're in good shape. You don't need any more than that, because you are certainly going to turn at least some inventory over into cash at some point in the next 12 months. And probably a result of 0.8 is not necessarily bad. So even if you don't have enough cash on hand, like I said, you are going to cover some inventory. But what you don't want to do is overcount your inventory and rely on it to cover all of your expenses, because something could happen, like, I don't know, COVID or something like that. So
just to be clear, when you're talking about ratios and you're saying your result, you're talking about the division of the two, correct?
Yes,
Okay.
absolutely. So if you have $1,000 of cash and $1,000 worth of inventory and $1,000 worth of expenses over the course of the year, we're not looking at your inventory. So 1,000 divided by 1,000 is 1. You're in good shape. Growers don't have inventory, so it's easily eliminated. They have some assets that could be similar to inventory, like they sold their inventory, but they don't know how much they're going to get paid for it. We do want to count that. That is going to require some forecasting because we don't know the price yet. So you just conservatively count that. I would base it on a hybrid of what historical grape prices are and what, a short-term history, like what you got paid last year, and also over the long term. So, I think we have a good idea of what those trends are. So for this year, the 2020 crop, I might expect $280 to $300 a ton in the cooperative markets. Probably somewhere around 200 of that is going to be counted towards your current assets, because some of it's going to go to paper, and I'm going to reduce that price a little bit just in case things don't go quite as planned. So if that price was $270 and you don't count the certificates and you don't count what you have to wait more than 12 months for, maybe you're at $200 a ton over the next 11 to 12 months.
And growers can reach out to you and talk to you about this if they're having.
Yeah.
Sometimes finance stuff is hard to grasp.
Mm-hmm. Mm-hmm.
So you're that. Just so you know, there is a wild cat in this office who may make an appearance, and I keep hoping she doesn't jump up here.
Well, you've got that virtual background, so we'll see what that looks like. It might hide her until she starts standing on your head.
It's going to happen.
So, and the other thing to keep in mind, another reason to maybe contact me is, if you get a current ratio or a quick ratio that's completely out of whack, you don't need to freak out about it. These results are going to vary a lot from farm to farm based on individual circumstances. Some of that variance is concerning and some of it's not. And if you want to walk through that with me, that's great. We could definitely do that. Something as simple as switching processors, people do that. It can completely change for a year or 2 or 5 these ratios. And, it's something to be aware of. If it's literally going to mean you can't pay a bill, you do have to do something about that. It doesn't necessarily mean your long-term business goals are unattainable or you need to go out of business. It just means you need to react, and you need to understand why, if you need to borrow money, you need to borrow money, and it's okay. Or you need to understand why you can't borrow money, and maybe your business isn't as ridiculously healthy as it looks. For example, if you switch from a cooperative to the cash market, you're going to have an influx in cash. So you're waiting for money, and then now all of a sudden you're getting it all at once. That's going to look really good on paper in the short term. In the long term, it might be fine, but it's not going to be as great as the short term looks. So what that means is sometimes your current ratio, sometimes your liquidity looks just fine when your overall business health isn't. And sometimes just the opposite is true. And we do need to take a look at both to try to plan on what you should do if there is an issue with liquidity, because what you should do changes dramatically whether or not you have long-term profitability or not.
And you're here to help them walk through
Absolutely.
that process. Thank
Yes.
goodness. All right. Well, thank you for your discussion on liquidity. If anybody has any questions or comments, please leave them below or feel free to email us or call us. I just want to make sure that you are aware we are available, even though that the official building, if you go to the building where our offices are, they will be locked and you won't be allowed in. But please call us, use email, reach out to us. We are here for you. We told you. No. Okay. Have a great day, everybody.
That's perfect. So yeah, and we'll be back next week for some more updates. In the next couple of weeks, look out for cash market price announcements. It's going to be time to start doing some pedigle sampling. So we're going to be talking about all that in the next couple of weeks. Thanks for joining us this week, and we'll see you soon.
Take care.